Hey guys, it's Mr. Schmidt here, and in this video, we're going to look at the money market. So, the money market is just what you think it is. It's the supply and demand for money, okay? And what we're going to do here is draw the graph and then kind of dissect it, much like we did with the loanable funds market. So, we're going to start with our axes here. And the labels for the money market, down at the bottom, we're going to have quantity of money. You can abbreviate this with Q if you would like. So you can do Q. And at the top, we got to be very careful here because remember, with the loanable funds market, it was the real interest rate. Here in the money market, it is the nominal interest rate. And I apologize that it does not want to give my eyes dots. So if that bothers you, I do apologize. But it is not my intention not to have dots on my eyes, but it's not wanting to let me do that for whatever reason. So nominal interest rate, you can abbreviate that with a lowercase I. Well, there you go. It gave me one dot on that I. So now in terms of building out the graph, so money demand is going to be downward sloping, just like most demand curves we drawn in the course. The supply curve, however, is going to be perfectly elastic, is what we would call it in micro. However, in macro, we can't use elastic terms, so we're going to call it vertical. Money supply vertical, and then we've got our equilibrium quantity of money and our equilibrium nominal interest rate right there. Still not wanting to do the dot. There we go. We got a dot. Wow, it's a lot more work than it needs to be. Okay, so that is the money market as a whole here. So we see downward sloping money demand, vertical money supply. Again, this is showing the supply and demand of money that is made available in the economy, right? It's, again, that's about money available. We're not talking about the total number of physical dollars that exist. We're talking about the money that people either want / the money that is being made available to people who want money, okay? So let's go ahead and break this down a little bit. So the money demand curve is how much money people are willing and able to hold at a given nominal interest rate. And by hold, I mean they want to take it for themselves and then hopefully go and spend it, right? You tend to hold money to want to go and spend it. And so the higher the interest rate, the less money people want to hold, as that money could be in the bank earning them interest. So you can think about this in terms of opportunity cost, right? What's the opportunity cost of holding money? Well, it's the interest you would have earned had you kept that money in a bank account. And so you can see by the graph, the higher the interest rate, the less money demand or quantity of money demanded, because people would rather keep that money in a bank where it can earn them interest as opposed to holding on to it where it's not earning them any interest. So that's why money demand is downward sloping. So that's the money demand curve, MD. The money supply curve is how much money is available in the economy at a given nominal interest rate. And yes, this is the M1 / M2 we were talking about in topic 15-1. This is the money supply, right? It's an actual curve, not just an idea. And so you notice here the money supply is fixed and set by the Federal Reserve. And the Federal Reserve, we've kind of mentioned them a couple different times. They are what we call, and we'll talk about this in a future video in this unit, but they are a central bank, meaning they are the most important bank in a country. In this case, the United States. They are the ones who set the money supply. And what we notice is that the amount of money available in the economy, if you look at the graph, is independent of the nominal interest rate. It does not matter what the nominal interest rate is, there is a fixed amount of money that is available in the money supply at any one time to people who wish to pull the money out, to hold on to the money. So that amount is set by the Federal Reserve, or the Fed, and they are the only ones that can change it. That's the idea of the money supply. It is a vertical curve. The nominal interest rate will not influence it. It's just one set amount, and the only way you can move it is if the money supply curve shifts, and the only one who can do that is the Federal Reserve taking an action that would cause it to shift. So that's money supply. Now, in terms of shifters, so for money demand, there are three. The first one's price level. So if the price level increases, that means things are more expensive. And so people are going to need more money to buy the more expensive things. And so money demand is going to increase or shift to the right because people need more money to buy the more expensive stuff. Whereas if the price level falls, okay, that means there's a lower price level, less inflation, things cost less money, and so people don't need to hold as much money, right? And so you should already be thinking about, this could really connect with aggregate demand and supply, right? Like as an example, a question could say, okay, aggregate demand is shifted to the right. What is the impact on the money market, right? So start thinking about those connections between these graphs. That's really important for the macro exam. The second one is GDP. If there's a higher GDP, real GDP, then there is a wider variety of goods and services available to people to buy. And so people are going to want to hold on to more money to buy this greater variety of goods and services. You could also think of this as a higher level of income. If people have more money, they tend to want to hold on to more money so they can spend more money, right? So money demand would shift to the right. Whereas if there's a lower GDP, there's less goods available, or there's less income, people have less money, they're going to hold on to less money because they're going to buy less stuff because there's less goods and services available to them. And so money demand will shift to the left. So money demand is all about how much money does a person want to hold on to. Finally, money substitutes. So for example, if credit cards, debit cards become more prevalent, then people don't want to hold on to as much physical dollars. And so money demand would shift to the left. Whereas if the government, or like Bitcoin, if Bitcoin became more popular, there was a 60 Minutes interview with the Federal Reserve Chairman, Jerome Powell, where he was asked about whether the United States was considering a digital currency, and they are working on a digital currency. So if that became the case, less, physical dollars would be demanded, and so money demand would shift to the left. Whereas if there are less money substitutes, so if debit cards went away, credit cards went away, then money demand would shift to the right because people need to hold on to more physical dollars to go buy the things they want instead of relying on debit cards, Apple Pay. There's your Apple reference for this video, whatever the case may be. Now, you're going to get a little disappointed, maybe, when I talk about money supply, or maybe a little frustrated, because the money supply can be changed by the Federal Reserve when it engages in monetary policy. So monetary policy is the mechanism by which the Federal Reserve changes the money supply. And as we're going to see in future videos in this unit, by changing the money supply through monetary policy, the Fed can stabilize the economy, much like the government can do with fiscal policy. So you'll see that in later videos. So right now I'm leaving the shifters of money supply to be a little mysterious, but when we start talking about monetary policy in the next video, you will see exactly how the money supply curve can shift. So that's all for this video on the money market. Until next time, have a great day.